Alright, come on then everyone, as we head into European trade on Tuesday the 16th of April. We flick across markets, but really markets are just looking at what we were looking at yesterday. Asian shares sliding, US rate cut rethink, but again, economic data again out yesterday out of the US retail sales coming in, much above consensus 0.7, I think it was off the top of my head, versus a consensus of 0.3, and then last month was upgraded from 0.6 up to 0.9. So again, strong economic data, and we were talking about it yesterday. Any positive economic data is a step further away from interest rate cuts. Any negative economic data is a step closer to interest rate cuts. Again, we've had a raft of economic data. So I covered all yesterday, and rallies or dips bought back into on the US dollar, compounded today by sterling. Sterling pushing lower, UK unemployment rate rising by 0.3% over the month of March, which is a pretty big jump in terms of 1 month. So kind of brings rate cut prospects forward, you'd imagine, from the Bank of England, and makes it more of a kind of a realistic scenario. Let's see how inflation comes out tomorrow when we get it. Funds make biggest bet against the yen since 2007. I can kind of view that the other way. I think we'll have a look at the Japanese yen, or dollar yen, should I say, when we get around to oil prices rise and solid China growth, Middle East tensions. Some numbers are strong, some numbers were negative. Oil's kind of up slightly, but you can see stock index across the board. Look at Asia Pacific stocks. The Nikkei, the Hang Seng, the Asia Pacific region, the Australian stock index all down 2%. Chinese stock index down 1%. You then look at European equity futures, European equities are quite heavily linked to China. They're all down over 1% as well. The US indices down. They had a solid downside in yesterday's session. Kind of more today's move than it is yesterday. The fact that it's only down by a slight amount, but we'll have a look at that when we get around to the charts. And they had a pretty big sell-off in yesterday's session post retail sales. US dollar higher across the board. US yields higher across the board, and that's not really much of a surprise now, is it? Your Aussie and Kiwi down in line with China being down, in line with stock index being down, so no surprise there. You see your Japanese yen higher across the board. The only thing it's not higher against is your US dollar. So classic risk off trading to start the day. We haven't even got to 8 o'clock. Kind of what you would expected, probably more at the open yesterday. Didn't really materialise until you got that retail sales data out of the US, and you'd have to imagine the markets become more and more, I'm going to say comfortable, probably not comfortable, but more and more awake to the fact that these interest rate cuts that they hope for is probably not going to come. You can see Chinese data, a few positive, a few negative. You can read into the GDP figures out of China, 5.3 versus a consensus of 5.5. So they're strong. Industrial production down on consensus, down on previous. Retail sales, consumer spending is not really kind of too much of a influencing factor in terms of the Chinese economy, but fixed asset investment into the real estate sector and stuff, where a lot of wealth is tied up on. Now that figure was positive. Now GDP quarter over quarter was pretty good. The unemployment rate didn't matter too much in China, but is still below previous, in line with consensus. So I don't exactly think that's dreadful economic data. I think markets are kind of more driven by fears of no rate cut rather than anything to do with this economic data, I would imagine. Not imagine, that is my opinion. Unemployment rate out of the UK, you can see 3.9 previous, 4% consensus, then a 4.2% rise, or a 0.3% rise up to 4.2 when it comes to the labour market in the UK. Average earnings up slightly in consensus, in line with previous, but that doesn't really matter too much when the unemployment rate rises by 0.3%. That's caused a bit of downside across sterling. You can see sterling having a go again. It has had a pullback actually since I started this video, but the trends continue. Dollar yen up above 154.50 now. We'll have a talk about that in a minute, but you can see your Aussie, Kiwi, Euro and sterling continue to trade lower, or continue to trend lower, should I say. Any rallies on them should be sold back into. We were looking at that yesterday when we were a little bit higher. And any rallies on them, I think have to be sold back into going forward. And then dollar Swiss, dollar CAD, dollar yen, any dips on those should be bought back into. Dollar yen's a bit more of a tricky one though. Dollar yen, this one. 152 is when they've intervened previously. If I just get this and stick it at 155, that is the that's the other level that some people had touted. Where is that going? Up here. So we're still a bit away from it, 50 odd pips away from it. But if hedge funds are net short the Japanese yen the heaviest amounts since 2007, right? That means they're all long dollar yen basically, and if that does then turn around and have an aggressive push lower, you'll have the central bank backing a move lower, the central bank pushing this lower, plus then you'll have all those short positions in the Japanese yen have to be cleared out. So you should get an aggressive move, anywhere up towards 155 in today's session. If you get up 155, 154.70, 154.80, I don't think selling that with a stop loss, even get a stop loss up at 156 and have a 120 pip stop loss, still don't think it's a bad idea. I think you should probably get at least below 150 on any central bank intervention, certainly in the aftermath of it as well. So I think it's definitely something that should be on everybody's watch lists as we go on through the rest of the week. Equity markets pretty flat overnight. You can see out of the US, but heavy downside yesterday. The S&P, the Dow Jones, the Nasdaq and the Russell. Where did they actually finish up in terms of cash equities yesterday? Dow Jones only down 0.6. Did have a bit of a bounce back to start the day, but Nasdaq down 1.6, the S&P down 1.2. They include then the rally that we saw overnight. So kind of from the high to the low in yesterday's session, a 2% drop across the S&P. The Nasdaq could be up closer to 3 at 2.6, 2.7%. So aggressive downside in yesterday's session. That has dragged European stocks with it. So you can see the DAX, the Euro stocks, the FTSE. But each time you kind of sell off aggressively like this, markets try and bounce back. So we were talking about yesterday. Over the long run, over the course of your trading career, kind of delusionally buying the dip in equities ends up a profitable strategy come the end of your trading career. Does it make much sense for these to go higher at the moment? Absolutely not. Now the logical explanation is to sell stocks. Any rallies on these should be sold, as we said yesterday, but shorting stocks is never the easiest of trades. So if you want to steer clear of that, I completely understand it. I'm gonna go and play that in other ways. Maybe you could sell something like Aussie yen, kind of a bit of a proxy for something like this. Aussie yen kind of just moves like the stock indexes, especially if dollar yen, you're expecting some intervention on dollar yen. Any rallies on Aussie yen might be a bit of a safer way to play it. But US yields continuing higher again today. Solid upside in yesterday's session. Bit of a pullback overnight. Now they're looking to go again. So a bit of a pullback into the close yesterday. Now they're looking to go again. But the looks of it, the 10-year yield, 2-year yield rejected 5%. Now not 2 days in the spin. Thursday of last week and then yesterday. So be interesting to see if we can get back up to 5% and then break 5%. It's just trending higher, the 10-year yield. So if the 2-year can get above 5%, that again should be kind of positive for further positive for the US dollar. And it kind of doesn't seem much in the way of stopping the US dollar at the moment. So that's the trade. That continues to be the trade. Buy the dip on the dollar. Probably sell rallies on equities, although it's probably a more difficult trade at the best of times. And then oil, probably steer clear of oil at the moment. A little bit tricky to kind of wrap your head around. Gold, in theory, the logical thing to do with gold would be to sell it if yields are moving higher. The dollar is moving higher. Just doesn't seem to want to go down though. So logically you would sell gold in this scenario. Doesn't seem to want to play ball though. That's kind of what we're thinking heading into today. Long dollars on any, add any dollar positions on any dips that you can find. You probably want a bit of a sell-off. Whether you can get one today is a different question. But economic data, the rest of the day, you got inflation out of Canada. Maybe that's an opportunity to get long dollar CAD on any miss on a consensus. I don't know why we don't have a consensus here, but expected inflation at 0.7%. If you can miss consensus on this, if you come in below 2.8% or even a third consecutive month below 3%, well, that would be a third consecutive month below 3%. Core CPI back to 2.1. You can see trading economics forecast for this down at 1.8, 2.7 for the headline figure. Both of them within that 3% target range. That would be a third consecutive month for the headline figure. So that kind of is a situation where they can go and cut interest rates, and they did communicate to markets last week that they are eyeballing a June cut. This will further reinforce that if you keep below 3%. So dollar CAD longs may be a decent bet a little bit later on. Goes in line with some building permits figures. Again, not the highest impact of high impact data releases, but if they can be consensus again, it's further positive economic data. So that would be the perfect scenario a little bit later on. Dollar CAD longs off the back of weak inflation. It should be a pretty good trade if that does materialise a little bit later. But for now, there should be a few opportunities out there. Good luck trying to find them.